All right, well, I know folks are still starting, but let's go ahead and jump in. Hello, my name is Steve Dufault. I'm Corporate Defined Contribution Practice Leader at Fiducient Advisors. We are absolutely thrilled to have you today for this conversation of Secure 2.0, in which we'll be discussing the key considerations for defined contribution plan sponsors. I'm absolutely pleased to be joined by Aliya Robinson of T. Rowe Price. Aliya is Managing Legal Counsel, Legislative and Regulatory Affairs for T. Rowe Price. She works on all retirement-related policy issues, including coordinating the company's policy position and engaging with industry associations, policymakers, and thought leaders. Among her prior experience, Aliya was Executive Director of Retirement Policy at the U.S. Chamber of Commerce. Aliya, thanks for being here today.
Thank you. I'm very happy to be here and appreciate the invitation.
Thank you. We'd love for this to be an interactive session, as interactive as a Zoom can be. We've enabled the chat function for Aliya and me to be able to review and see throughout the presentation today. Please feel free to submit your questions throughout, and we'll do our best to address them during the conversation. If we don't address something, please feel free to reach out to any of the professionals at Fiducient, and we'll make sure we get answers for you. All right. Well, I'll tell you what, before we jump in, we have a lot to cover in terms of Secure 2.0, but it might be helpful to share a little bit of insights onto kind of how we got to Secure 2.0. Over the last 20, 25 years, there's been quite a bit of regulation. Maybe you can kind of bring us up to speed on where we've been and where we're going.
Sure, that makes me feel old thinking about that. It's been that long, but it has. We started, and I'll start back with the Pension Protection Act of 2006. And that was considered huge legislation. It took a long time to get through, but it was really a corrections bill. It looked at funding rules for single employers and multi-employers and tried to do a correction there. It looked at correcting cash balance conversions, but there is a piece of it that's very important for defined contribution plans that I think people have forgotten about. It used to be that auto enrollment was a sunset provision. And I can only imagine now, the PPA made that a permanent provision. So I can't imagine having to go through and every year reauthorize auto enrollment. It's become such a significant part of the retirement space. And that happened in the Pension Protection Act to make that permanent. From there, it was quite a bit of time until we saw the next big piece of pension legislation, which was the Secure Act in 2019. However, even though that amount of time passed, there was still a lot of work being done. One of the provisions in the Secure Act was something called the Lifetime Income Disclosure Act. That piece of legislation was introduced in 2008, but we didn't see it enacted until Secure in 2019. So that shows you how much work there was going on and how long that work was going. And then we have Secure Act, the Secure 2.0 Act that just passed in 2022, which a lot of people are saying is rapid speed. But let's not forget, there was other retirement legislation. We had the CARES Act in 2020, and we had the American Rescue Plan, which looked at defined benefit plans, single employer and multi-employer in 2021, and then this in 2022. So for the last 4 years, we've seen pretty significant retirement legislation. Of all of those focuses were really on, I would think, plan administration, plan design, and kind of correcting where the plans are going. What's exciting about Secure 2.0 is that I think there's a lot of focus on plan participants and really focus on the participant side of the plan design.
Yeah, really improving participant outcomes, right? By getting people into the plan, getting them, encouraging more savings, and providing more flexibility as well.
Exactly.
Great. Secure 2.0 was in the making for quite a long time, and there seemed to be significant bipartisan support for this act. What took so long? Like, why did it take until the second to last day of the year to get this passed?
Politics. It was bipartisan. There was a lot of agreement, but even with that, there was political. The bill was bipartisan. Unfortunately, it was in a Congress that wasn't as collegial, and any movement, not just in this Congress, it has been around for the previous Congress as well. would be seen as a victory for the other party. And so it was really necessary to have the proper context for the bill to go through, not necessarily by itself. And the omnibus bill presented just a perfect political opportunity to get this bill passed.
Yeah, and some pretty prominent senators were retiring that wanted to get this passed as well.
Exactly, that always helps as well to give them a legacy.
Absolutely. All right, let's go ahead and dive in here. So with over 90 provisions, there is a lot to talk about. But broadly speaking, before we get into the actual details, what's the broad theme of Secure 2.0 from your perspective?
Yeah, so as I mentioned, this one, the Secure 2.0 is much more participant focused. So we do see a focus on increasing savings, increasing participation, also simplification, and not just, obviously that's good for plan sponsors and on the plan side, but it's also simplification for participants. And we'll talk about some of those and how that impacts some of the provisions as we go through them. And then finally, Rothification, which I think is finally a word now. But we do see a lot more Roth features than we have previously in this bill, and we'll talk about those as we talk about the individual provisions.
Great. Urban Dictionary will love Rothification. Well, this as we brought up the slides here that we're going to go through today, there's a lot of complexity. Number one, there are some provisions that are mandatory, quite a few that are optional. Some of the optional ones, there's a lot of excitement about, like student loan matching, plan linked emergency savings are some of the key ones that plan sponsors are interested in. But rather than just just randomly select things, why don't we go year by year and talk about the key initiatives that we have up on the screen? I want to remind our guests today that we're focusing on defined contribution only, and these are just high points. There are quite a few things that Aliya is going to reference during our conversation that are not listed here, but there's a lot more to come. And the reason there's a lot more to come is that while the legislation provides the broad framework, all of the details still need to be worked out. And that's where a lot of the complexity comes in. So we'll go through some of that today. So let's start with 2023. What do we need to know? And hopefully folks are aware of the first one at least.
Exactly. And thank you. I do have two caveats before we start. And one you already mentioned, Steve, there are 90 provisions. And we have a half hour. So we are not going through all 90 today. Also, there is a lot of detail and complexity. I definitely want questions and anything you have concerns about. If I cannot answer it for you right now, I'm happy to follow up later as well, as I am still working through these provisions as well. So starting with the RMD, you're absolutely right. I hope everyone is aware of this one already. Another, I will say, minor theme people should be aware of is that the budget. In order to get this on an omnibus bill, it was really important that this bill be paid for, all the retirement provisions be paid for. So when you see things that kind of don't make sense from a policy perspective or administrative perspective, you can probably guess that it had to do with the budget, and the RMD age increase is definitely one of those. So we have a two-step increase, one that's immediately that started January 1, 2023 to increase to age 73, and then in 10 years it's an increase to age 75. The previous proposals, one was a step like every 2 years, increase up to age 75, and then one proposal was a one-time step, I think it was 7 years to age 75. So this is a bit of a compromise because the increase is pretty expensive. And so it's 1 year now, and then the next increase is outside the budget window, and that's how they were able to afford this increase. What that means for plan sponsors is that there's a lot of work to do, a lot of work that was probably done at the end of the year and still continue to be done for that age 73 increase. And then you get a break for 10 years until we get to age 75. As many people have probably heard, there is a technical correction that has been noted here. For those who were born in 1959, it's not clear, or it seems to be that they have two R&D ages of 73 and 75. And I will say generally, we'll talk some more about some other technical corrections, but in general, for every bill, there's anticipated, especially a bill as big as this, that there will be a technical corrections bill that addresses this. But also regulators are pretty understanding in terms of when there is this kind of technical glitch, and will defer to the intent of the legislatures. And so you won't get enforcement that's so detailed to the letter of the statute when they know that this was really a technical glitch.
Well, I think that's I think satisfying to a lot of plan sponsors, right? To know,
Yep.
hey, the law might be out there, it might be, effective, but practically speaking, no one's going to get in trouble because of the technical errors.
Right.
So we just had a question.
I did see a question.
Yeah.
And I'm not sure. I might have misspoke. It is 10 years. So I apologize if I said 2 years, but it increases to age 75 in 10 years.
Great. Thank you.
Yes.
So maybe moving on to the employer Roth contributions. We've already gotten a number of calls from plan sponsors saying employees are itching to get this done.
Exactly.
So maybe you can explain it, and then I'll share a little bit of insights from a record keeper standpoint.
Terrific. So again, and here we talk, this is also a budget issue when I talk about Rothification being a theme for this bill. Roth provisions are seen as a kind of harmless way to pay for things, but we are getting to a point where we're running out of Roth conversion options within the retirement system. And what I think is particularly interesting or telling about the Secure 2.0 is that we've seen our first mandatory Roth provision in the catch-up contribution space. And so for plan sponsors that either don't have Roth options in their features or have not done a lot of education or work around Roth features, I think this is very telling. And this might be a time to start considering how to ramp up your Roth features education and get participants to understand how these work, because I think this is something that we are going to continue to see more of. But for this bill, the catch-up contributions, we do see that catch-up contributions are now mandated to be Roth for anyone who makes over $145,000. Again, this is a mix of budget and policy, and the concern that did not want to discourage participants who made lower earning participants, did not want to discourage them from making catch-up contributions because they didn't want them to be Roth. So there are a couple of questions about the catch-up contributions as Roth. One is answered in the statute. The question was, can you only allow people who make under $175,000 to make catch-up contributions? No, you cannot. If you have any employee that is eligible for a catch-up contribution that makes over $145,000, you have to have a Roth feature available for that catch-up contribution. You cannot limit them. However, it is not clear if someone under $145,000 can be mandated to have a Roth. So that's not clear in the statute right now. Or can be allowed to have a Roth even to make it into a Roth contribution. There is a technical glitch, another technical glitch here. This one is a bigger one. It seems that in removing some of the language or trying to coordinate some of the language, they've removed the provision that would allow catch-up contributions at all. Congress is aware of this. The agencies are aware of this. Again, I think we are going to have to rely upon common sense and the fact that regulators will understand that Congress did not mean to get rid of the catch-up contributions completely. Congress is aware and they are working on it, but it is Congress, it is political. So we might not get those answers from Congress as soon as we would like, but hopefully we will get answers from regulators to let us know that they won't be enforcing against what is technically in the legislation.
So a lot of news stories that came out in the last day and a half on that technical glitch. Probably something not to be overly concerned about from a plan sponsor perspective. Is that fair to say?
It is. It is.
Yeah. Good. Something to catch the headlines, but probably something to know that's going to be satisfied.
Right. And it's good that it's getting attention. So Congress is aware of it and can address it. It's also good so that, the regulators are aware of it and, know how to deal with it. So the attention isn't a bad thing, but it also isn't something that plan sponsors need to be, I think, overly worried about.
Excellent. We have a couple of items here listed under self-certification, and maybe just talk a little bit about, relieving some pressure from plan sponsors in some of their administrative duties.
Absolutely. So self-certification, this one I think falls into not only simplifying the process for plan sponsors, but also for participants. So a participant can self-certify now hardship distributions and just let the employer know that they need the hardship distribution, and also self-certify the amount of the hardship distribution. So it's simpler for both. Plan sponsors don't have to keep track of this information. They don't have to, and a lot of plan sponsors don't want to know that detail of their employees' situations and trust that the hardship is a hardship. But for the participant, they don't have to be burdened with showing documents and proof and getting letters from places, etc. As you mentioned, there are several places we see the self-certification. Another place and another provision you mentioned that that's getting a lot of attention is the student loan matching. So we do see student loan matching allowed now. This is something that had been done in the IRS, and the IRS tried to address, but was limited by statute. And so from the regulations, even though it was called a match, it was technically a non-elective contribution. And so that created a lot of issues in terms of non-discrimination testing and some definitions for certain kinds of plans. So now what happens under the statute is that any money that is made due to a student loan payment into the plan is considered a matching contribution and not that non-elective contribution. So it gets rid of that issue. But again, to go back to the self-certification, the employee is able to certify that they've made the payment on an annual basis. I will say there's one question I've heard about. Well, this is a complicated provision. There's a lot of details in it, but one question that's come up with this annual certification is whether the match cannot be made until you get the annual certification, meaning it's just a yearly match, or if the match can be done periodically to the terms of the plan. Again, the regulators are aware. I think that is something they will try to answer as quickly as possible. Student loan matching, we have another year, which isn't far away, but it is further away than the more immediate provisions.
Yeah, I mean that has been a lot of interest by a lot of clients with that matching contribution, the student loan matching. So just to clarify, the plan sponsor doesn't have to track that the participant is paying their student loans off, but the participant has to certify it. I mean, do you envision like enforcement of that somehow? I mean, how couldn't an employee just say, yeah, I paid some student loans? There's got to be some type of documentation that a plan sponsor is going to have to know that they actually have a student loan.
So, well, and that's true. So there might be some sort of initial documentation to say that there is a student loan that exists. But again, this is meant to be simplification for both the participant and the plan sponsor. They don't want plan sponsors to be burdened with having to track this. Having said that, there are a lot of service providers that do already track this because this wasn't in the statute and it wasn't clear how it was going to work. Service providers do coordinate with the student loan payments and have ways of tracking it. So again, the statute doesn't recommend it, but obviously if plan sponsors feel more comfortable doing that, that would still be an option.
Excellent. Just a clarification that the boxes with an X, those are mandatory provisions. Everything else are optional provisions. So just wanted to clarify that. Let's talk a little bit about plan linked emergency savings. What is that? How does it work? A lot of excitement about this one as well.
Exactly. So there are two emergency savings provisions, and these were a lot of excitement and a lot of interest in both of these. They are both optional. They are not meant to, I'm not sure if you can implement both. I'm not sure you would want to, but they are meant to give plan sponsors different options for emergency savings. So the plan linked emergency savings is a very detailed provision. I'm not going to be able to get through all the provisions. But just generally, it is an account that is treated as part of the defined contribution plan, although it is maintained separately for bookkeeping purposes. employees are allowed to make up to contributions up to $2,500. However, if gains go past that $2,500, that's okay. It's just contributions that are limited. Employees or participants are allowed to make up to 4, I believe, withdrawals a year. Fees cannot be imposed for the first 4 withdrawals. After that, only reasonable fees are allowed. And again, this is a self-certification of the emergency provision. So employees do not have to tell the plan sponsor that they have an emergency. They don't have to say anything. They are able to make these withdrawals from this account themselves. There are the contributions must be made on a Roth basis. So we do see that Roth provision coming in again. And there are a number of other tax provisions for terminating either the account or when the employee is terminated and how those monies are handled at that point. For anyone, a plan sponsor who's interested in the plan linked emergency savings, I would definitely recommend talking with the service provider and getting the details on this, because there are a lot of details in the statute. And so that means there'll be even more details coming through regulation on this. The second emergency withdrawal provision, emergency savings provision, is really a straightforward withdrawal provision that's similar to what we saw with the COVID withdrawals. So it's a penalty-free withdrawal that's allowed. I believe up to $1,000. I might be wrong on that. Sorry, on the amount that a participant can make at least once a year and is able to remake or re-withdraw that amount if they pay it back.
Okay. Back to the plan linked emergency savings. There's also the availability for a plan sponsor to match on those contributions. Is that correct? That's an option, or is that required?
So the plan sponsor does not have to provide a match on the contribution. However, if the plan sponsor provides matching in the plan, those contributions can be matched as well, must be matched as well. Does that make sense? So yes, there's not an extra match required, but if the plan already allows for matching contributions, then those emergency contributions must also be matched. They do not go into the emergency account, they go into the regular plan, and those matching contributions are not available for the emergency savings. They are part of the regular plan.
Excellent, excellent. A question just came in. Let me see if it really relates to this. Okay. Are the emergency savings above the IRS limits? I'm assuming that the answer is no.
No, they are all subject to the same limit. So it's accounting purposes, you have a separate plan, but for the limits, it is considered all the same plan.
Okay. There was a question that came in about the automatic enrollment provisions. I think it's really important to let plan sponsors know that only applies to new plans after the first of this year, right after 1/1. So existing yes, plans do not have to abide by the automatic enrollment provisions in there.
Correct. Correct. There, I will say there is some question here about plans that merge, if that's considered a new plan, or if a plan joins a pooled employer plan or a multiple employer plan. But if you're just running your plan the same way it's always been, you don't have to worry about the auto provisions.
Okay. Sounds good. Let's see. Yeah, are you able to comment on the question that just came in? Did you see about the mandatory Roth catch-up provision?
Right. I am not sure about this one. There are different rules for SEPs, simples, and I haven't looked at the solo 401k, but that is something I can take a look at and get back to you on. I just haven't looked at that specifically. So the question is whether the mandatory Roth catch-up only provides W-2 employees and that business owners don't have to comply if they have a solo 401k.
Yeah. Yeah. So a lot more to come, right, on all of these details.
Yes. And I will say, so for the most part, most of these provisions apply to 401ks, 403bs, and 457s. A lot of the provisions have parallel provisions for SEP, simple, solo 401ks, but a little bit different. So I haven't focused on those. So if you're working with those plans, definitely take a look, because there will be parallel provisions in most cases, but with some differences.
Excellent. Let's the last two items in 2024 are pretty interesting. The automatic portability. This is a way to help continue to build retirement savings for employees. Maybe walk us through those last two if you could, and then we'll go on to the next couple of years.
Sure. So the auto portability, this is a prohibited transaction exemption that allows service providers to automatically move monies around and still get a fee for that porting money over. A lot of details, again, because it is a prohibited transaction exemption in terms of how that works. And there's definitely limits on portability for service providers that are working with their own plans. So definitely, if you're working with your own employees, you want to take a hard look at those rules. But it is meant to help participants, especially on the smaller end, make sure that to prevent cash outs, leakage, etc. Now, having said that, we do also have an increase in the automatic cash out limit to $7,000. It's an increase from $5,000. This was seen as, helping plan sponsors who that limit has not been increased in decades. And it's also not indexed. So that's a static $7,000 number. But it is meant to help employers who are trying to clean out the small accounts. And it's seen as a complement both to this auto portability and also to the retirement lost and found registry, which we will talk about later.
Yeah, excellent. So again, not mandatory to cash folks out under $7,000, but optional to keep the books clean. And that's really important from an audit perspective, right? We've heard a lot about audits coming through looking for lost participants. Yep. So if you've got a lot of small accounts and you can't find those participants, it's not a great thing from an audit perspective. So great, good to keep those folks get clean, keep that as clean as possible.
Exactly.
So going forward, again, multiple years of lots of excitement. The first item here in 2025, just a very minor change in long-term part-time employees, really just reducing the amount of time from 3 years down to 2 years of that look back, correct?
Exactly. And this is a carryover from Secure One. I will just recommend looking at the details. So the vesting and how you count the hours of service, there are details around that. And when you start counting hours of service and how you continue to count those going forward, and also the transition between Secure One and Secure Two.
Yeah. Okay. We've got just a couple minutes left. Well, I think a couple of these we can summarize from the documentation standpoint, but the DOL lost and found, I think this is an industry game changer for participants just because of the mobility of employees these days.
So this is, it creates an online registry, and it will allow participants to search for any accounts that will be out there and puts them in touch with the plan sponsor. So it's not a repository for the monies. It is just an online database created by the Department of Labor in consultation with the Treasury Department. There are enhanced reporting requirements for plan sponsors to make sure to get this database set up. So you definitely want to work with your service provider to make sure you're doing those enhanced reporting requirements. What I think is very interesting about this one, and to your point, Steve, about this being a game changer, this is thought to cost $44 million, which says that they are expecting from the budget office for people to be saving or to be getting, saving $44 million in retirement. So that they're expecting a lot of use out of this for people to see it, find it, and continue to save in their plans.
Excellent. And then the paper statement requirement, we'll do that and we'll wrap things up.
Yeah, so this was, as you may remember, the Department of Labor at the end of 2019 issued final regulations saying you could use electronic disclosure as default option, and you only had to provide a one-time paper notice. That did not sit well with a lot of people, and so Congress came back and said now there has to be an annual paper statement for defined contributions plans, at least annually, that lets people know that there's going to be a default process. The good news is that there are 2 exceptions. One, that's always the exception. If the participant asks for electronic disclosure, you don't have to do this annual notice. But 2, if you're following the 2002 DOL safe harbor, which is basically the wired at work safe harbor, where people have access, you've provided email, et cetera, you can continue to provide the one-time paper statement. Again, details and more details will be coming from the Department of Labor as they update their regulations. But it's a new reporting requirement that didn't end up being as bad as we thought it was going to be.
Excellent. The takeaway for today is twofold. Number one, if you don't offer Roth 401k today, you need to get on that, right? Because of those contributions next year. Number 2 is understand that record keepers, trustees, custodians, payroll providers are all going through these details. And in speaking with the vast majority of the major providers, everyone is on top of these provisions and trying their best to be able to implement them. But patience is really going to be the name of the game right now. I know we're all excited about student loans and emergency savings, but it's probably going to be towards the end of the year until some of these items can be addressed from an admin perspective. With that being said, this wraps up our conversation for today. There's going to be a lot more that comes out over the next few months, next couple of years on this topic. We're planning a number of research white papers that will be posted to our website going forward. Also, we do have a blog post on Secure Act that goes into additional details on many of these provisions as well. On behalf of Fiducient Advisors, we want to thank Aliya Robinson, T. Rowe Price for joining us today. Really appreciate your insights. And please feel free to visit our website or any of our professionals that can help you navigate this exciting new legislation. Have a great day, all. Thanks.
Thank you.
Bye.